Joining us now from Brussels is Collins Nweke. He's a senior international trade consultant and African Affairs Analyst. Welcome to the programme, Collins. Now, can African grids realistically support energy-intensive refineries?
Well, Taib, it's a million-dollar question. Historically, the answer was a flat no. But 2026 marks a shift towards, what they call embedded power solution. Now, what we are seeing is a move away from, relying solely on fragile national grids and towards, mining energy hubs. These involve modular nuclear reactors, dedicated solar plus storage plants, the regional power pools like, the Southern African power plant or power hubs. These are all examples of such. For instance, look at South Africa. It entered 2026 with about 4,400 megawatt more capacity than, in 2025. The strategy now isn't just plugging into a grid, it's building the grid around the refinery. It's a massive capital hurdle, like you mentioned in your intro, but the African, continental system master plan gaining steam. The vision of a connected continent is finally moving from the boardroom to the bedrock, as a matter of fact.
Now, will Western capital accept these new local processing demands?
They don't really have a choice, do they? But they are negotiating the terms anyway. For a long time, Western investors viewed local beneficiation as a sovereign risk. In 2026, they see it as a supply chain security requirement. If the DRC or Zimbabwe mandates local refining, a Western OEM like, say, a car maker would rather have a refined product ready for shipping than raw ore that might get stuck in a geopolitical bottleneck. However, the buy-in comes with strings. Investors are demanding stabilization clauses to ensure that once they build a $500 million refinery, the tax laws don't change overnight. The capital is there, but it's looking for policy certainty to match, the geopolitical certainty.
And we heard about the Junior Mining Fund. Does that offer real liquidity there for smaller firms?
Well, it will, I will call it a vital shot in the arm, but it's not a silver bullet. The Junior Mining Exploration Fund, launched at Indaba, is specifically designed to bridge the valley of death. That gap between finding a deposit and proving it's worth a massive investment. It's a real, is it real liquidity? I would say yes. For the early stage explorers who have been starved of cash. In South Africa, for example, the fund is already providing grants that convert to equity upon discovery. But let's be clear about one thing, Taibe. The fund's primary job isn't to bankroll the whole mine, is to de-risk the project so that the big institutional whale, what I call the big institutional whale investors, feel safe coming in. It's about creating a pipeline of bankable projects, not just, handing out cash.
And do you think mining majors will actually commit to this capital?
Well, why not? In 2026, the gloves are off and the strategies are distinct. China is the industrial incumbent. They own the mines, they own the existing refineries, and, they move with incredible speed. Their strategy is, integrated ownership from the pits to the battery plant. The U.S., meanwhile, is playing a game of diplomatic offtakes. Rather than trying to buy every mine, the U.S. is using state-backed financing like DFC and Exim Bank to secure offtake deals, guaranteeing they will buy the minerals once they are out of the ground. They are also leaning heavily towards, infrastructure corridors like the Lobito corridor to ensure the minerals have a clear path to Western markets. So, essentially, China builds the factory, the U.S. builds the refinery, and, signs long-term contracts.
Right, we'll leave it there for now. Collins Nweke in Brussels, thank you very much for your analysis.